The white opening harami cross is a bullish candlestick pattern that is formed when a small white candle opens within the body of a large black candle. The small white candle indicates that buying pressure is starting to build, while the large black candle indicates that selling pressure was present in the previous session. The white opening harami cross is a reversal pattern, meaning that it is typically seen at the end of a downtrend. When this pattern is formed, it is a signal that the downtrend is likely to end and that the price is likely to start rising. Here are some things to keep in mind when trading the white opening harami cross. Pattern is more reliable when it is found after a prolonged downtrend. The wolf trap with hammer candlestick pattern is a bullish reversal pattern that is formed when a large bearish candle is followed by a small bullish candle with a long lower shadow. The long lower shadow indicates that there was strong selling pressure at the open of the candle, but buyers were able to push the price back up to close near the high of the day. This pattern is often seen at the end of a downtrend and can signal a reversal to the upside. To trade the wolf trap with hammer candlestick pattern, you would place a buy order at the open of the bullish candle or slightly above the high of the candle. Your stop loss would be placed below the low of the bearish candle. Your profit target would be based on your risk tolerance and the overall trend of the market. The Doji and shooting star are two candlestick patterns that are often used to identify potential reversals in the market. The Doji is a neutral pattern that can occur at any time, while the shooting star is a bearish pattern that typically occurs at the end of an uptrend. When a Doji is followed by a shooting star, it can be a sign that the bulls are losing control and that the trend may be about to reverse. The long upper shadow of the shooting star indicates that there was strong selling pressure during the day, which was able to overcome the buying pressure that had been present during the formation of the doji. Here is an example. The market has been in an uptrend for the past few weeks. On day 1, the market opens higher and rallies during the day. However, the market closes near the open, forming a doji candlestick. On day 2, the market opens higher but then falls sharply, forming a shooting star candlestick. This combination of patterns suggests that the market is about to start a new downtrend. When a doji is followed by a hammer, it can be a sign that the bears are losing control and that the trend may be about to reverse. The long lower shadow of the hammer indicates that there was strong buying pressure during the day, which was able to overcome the selling pressure that had been present during the formation of the doji. Here is an example of how the doji and hammer candlestick patterns can be used to identify a potential trend reversal. The market has been in a downtrend for the past few weeks. On day 1, the market opens lower and falls sharply during the day. However, the market closes near the low, forming a doji candlestick. On day 2, the market opens lower but then rallies sharply, forming a hammer candlestick. This combination of patterns suggests that the market is about to start a new uptrend. This pattern is characterized by a series of progressively smaller candles, followed by a breakout candle that breaks the trend. Typically, this pattern begins with a bearish candle, followed by smaller candles that shrink in body length. Shrinking candles continue until a bullish candle emerges, closing above the high of the initial bearish candle. With 3 shrinking candles between 2 significant candles, this pattern forms a small shrinking range configuration. Psychologically, it reflects anticipation and confirmation in the market. Initially, low volatility is observed as smaller candles suggest indecision. However, a breakthrough occurs when a confirmation candle surpasses the entire shrinking range, validating an upward movement. The bullish shrinking pattern offers traders an opportunity to identify potential bullish reversals and capitalize on market shifts. The doji and shooting star are two candlestick patterns that are often used to identify potential reversals in the market. The doji is a neutral pattern that can occur at any time, while the shooting star is a bearish pattern that typically occurs at the end of an uptrend. When a doji is followed by a shooting star, it can be a sign that the bulls are losing control and that the trend may be about to reverse. The long upper shadow of the shooting star indicates that there was strong selling pressure during the day, which was able to overcome the buying pressure that had been present during the formation of the doji. Here is an example. The market has been in an uptrend for the past few weeks. On day 1, the market opens higher and rallies during the day. However, the market closes near the open, forming a doji candlestick. On day 2, the market opens higher but then falls sharply, forming a shooting star candlestick. This combination of patterns suggests that the market is about to start a new downtrend. The long day white pattern is characterized by a single candlestick with a long and strong white or green body. This candlestick represents a significant price movement where the opening price is near the low and the closing price is near the high of the session. It indicates strong buying pressure and bullish momentum in the market. Traders often interpret the long day white pattern as a sign of continued upward movement, suggesting the potential for further price appreciation. It can be used as a signal to enter or add to a long position, or as an indication to hold on to existing bullish positions. The Rickshaw man pattern is characterized by a candlestick with a small body and long upper and lower shadows. It represents a state of equilibrium between buyers and sellers, where neither side has gained control. The candlestick resembles a rickshaw, with its body in the middle and long shadows extending in both directions. Traders often interpret the rickshaw man pattern as a sign of indecision and a potential reversal in the market. It suggests a balance between buying and selling pressure, indicating a possible shift in momentum. The pattern can be used to identify potential trend reversals and to anticipate price movements. The wishbone bullish pattern is characterized by a candlestick with a small body and long lower shadow, resembling the shape of a wishbone. This pattern suggests a temporary dip in price, followed by a strong reversal and upward momentum. Traders interpret the wishbone bullish pattern as a signal of bullish strength and a potential trend reversal. It signifies that buyers have stepped in, pushing the price higher from the temporary dip. This pattern can be a strong indicator of buying pressure and a potential entry point for bullish trades. The wishbone bearish pattern is characterized by a candlestick with a small body and a long upper shadow, resembling the shape of a wishbone. This pattern suggests a temporary rally in price, followed by a strong reversal and downward momentum. When traders spot the wishbone bearish pattern, it serves as a signal of bearish strength and a potential trend reversal. It indicates that sellers have stepped in, pushing the price lower from the temporary rally. This pattern can be a significant indicator of selling pressure and a possible entry point for bearish trades. The morning star with hammer is a bullish reversal candlestick pattern that consists of 3 candles. The first candle is a large bearish candle, the second candle is a small candle with a long lower wick, and the third candle is a large bullish candle. The long lower wick of the second candle indicates that selling pressure is waning, while the large bullish candle of the third candle confirms that buyers are in control. The morning star with hammer is a relatively rare pattern, but it is considered to be a reliable indicator of a bullish reversal. When this pattern is seen, it can be a signal to enter a long position. Here are some things to keep in mind when trading the morning star with hammer. The pattern is most reliable when it occurs after a prolonged downtrend. The pattern is more likely to be successful if the third candle closes above the high of the first candle. The upside gap 3 methods is a powerful bullish candlestick pattern that signifies a potential continuation of an uptrend. Let's dive into its formation and interpretation. First, we have a long and green candle representing strong buying pressure. This is followed by a gap up, indicating a significant increase in buying interest between the first and second candle. The second candle is also long and green, confirming the bullish sentiment. Importantly, the shadows of both candles should not overlap, reinforcing the strength of the upward move. Finally, we have a red candle as the third candle. Its open is within the real body of the first candle, while its close falls within the real body of the second candle. This shows that despite some temporary selling pressure, the overall bullish trend remains intact. The upside gap 3 method suggests that buyers are still in control and the uptrend is likely to continue. The pattern starts with a long and white candle, indicating a strong bullish momentum. Next, we have a white candle that gaps up from the first candle, creating a noticeable gap between them. The third candle is a black candle, and here is where the magic happens. Its close occurs within the gap created by the first 2 candles, with the close above the real body of the first candle. Furthermore, the open of the third candle falls within the real body of the second candle, adding confirmation to the pattern. An additional confirmation is when one of the subsequent candles achieves a higher high than the high of the second candle, further validating the pattern. The downside gap 3 methods pattern consists of 3 distinct candles. Firstly, we have a long and bearish candle, representing a significant downward move in the market. Following this, there is a gap down between the first and second candles, indicating a notable shift in market sentiment. The second candle is also long and bearish, with no overlapping shadows between the first and second candles. Lastly, the third candle is a bullish candle, opening within the real body of the second candle and closing within the real body of the first candle. This contrasting bullish candle within a bearish pattern suggests a potential consolidation or temporary pause in the downward trend. Traders often interpret the downside gap 3 methods as a signal for further bearish momentum, indicating the potential continuation of the prevailing downtrend. The upside window pattern unfolds with a strong bullish market sentiment. We observe a white or green candlestick that opens higher than the previous day's close, creating a window or gap between the two. This gap signifies a significant shift in market momentum, as buying pressure continues to drive prices higher. The upside window pattern often indicates a continuation of the upward trend, providing traders with potential buying opportunities. The wide range candle pattern is characterized by a single candlestick with an unusually large range between its high and low prices. This candlestick represents a significant price movement within a short period, reflecting intense buying or selling pressure in the market. The wide range indicates a strong shift in sentiment and often suggests a potential continuation of the prevailing trend. When the wide range candle appears in an uptrend, it signifies robust bullish momentum, indicating that buyers are firmly in control. Conversely, in a downtrend, it signals strong bearish pressure, with sellers dominating the market. Traders can utilize the wide range candle pattern as a signal to enter or exit trades, depending on the direction of the trend. Remember, successful trading requires comprehensive analysis, risk management, and discipline. Stay tuned for more exciting videos as we explore a wide range of candlestick patterns. This pattern consists of two candles, typically observed at the top of an uptrend. The first candle is a bullish candle with a long upper shadow, suggesting strong buying pressure. The second candle is a bearish candle that forms right after the bullish candle, with a small body. The critical characteristic of the Tweezer tops pattern is that the high of both candles align perfectly, forming a horizontal resistance level. The Tweezer tops pattern suggests a shift in market sentiment from bullish to bearish. It indicates that sellers have entered the market, rejecting higher prices and pushing the price lower. Traders often interpret this pattern as a signal to consider short positions, anticipating a potential downtrend. This pattern consists of two candles, typically found at the bottom of a downtrend. The first candle is a bearish candle with a long lower shadow, indicating strong selling pressure. The second candle is a bullish candle with a small body, forming right after the bearish candle. The crucial characteristic of the Tweezer bottoms pattern is that the low of both candles align perfectly, creating a horizontal support level. The Tweezer bottoms pattern suggests a shift in market sentiment from bearish to bullish. It indicates that buyers have stepped in, rejecting lower prices and pushing the price higher. Traders often interpret this pattern as a signal to enter long positions, expecting a potential uptrend. Upside gap to close is a bearish candlestick pattern that can signal a potential reversal in an uptrend. This pattern consists of three candles. The first candle is a long bullish candle, indicating a strong upward momentum. The second candle is a bearish candle that gaps up, opening above the close of the previous candle. However, it fails to maintain the bullish momentum and closes below the midpoint of the first candle. The third candle is another bearish candle that gaps up, opening above the close of the second candle. It continues the downward movement and closes below the close of the first candle. The upside gap to close pattern suggests a shift in market sentiment from bullish to bearish. It indicates that the buying pressure is weakening and sellers are gaining control. Traders often interpret this pattern as a signal to consider short positions, anticipating a potential downtrend. The Takuri line is characterized by a long lower shadow and a small body. It forms in a downtrend and signals that the bears are losing control and the bulls are about to take over. The Takuri line is a relatively rare pattern, but it is very reliable when it does form. In fact, studies have shown that the Takuri line has a success rate of over 60%. This makes it a valuable tool for traders who are looking to identify potential bullish reversals. Here are a few tips for trading the Takuri line. Look for the Takuri line to form in a clear downtrend. Wait for confirmation of the reversal by looking for a break above the high of the Takuri line candle. Place your stop loss below the low of the Takuri line candle. This pattern can provide valuable insights into potential market reversals and guide us in making informed trading decisions. The three mountain top pattern consists of three distinct candlesticks. Let's break it down. The first candlestick is a green candlestick, signaling an ongoing upward trend. The second candlestick is also green, but its body, open and close, is positioned below the close of the first candlestick. However, the high of the second candlestick is higher than the high of the first candlestick. Now, here is where it gets interesting. The third candlestick is a red candlestick, indicating a potential reversal. Its body, open and close, is positioned above the close of the second candlestick, but its high is below the high of the second candlestick. This bearish candlestick formation suggests a shift in market sentiment as the buyers struggle to maintain control, allowing the sellers to gain momentum and potentially reverse the previous upward trend. The bullish tri-star candlestick pattern forms with three consecutive Doji candles. A Doji candle is characterized by having open and close prices that are nearly identical or very close together, resulting in small or non-existent bodies. These candles indicate a period of indecision and balance between buyers and sellers. In the bullish tri-star pattern, the first doji candle typically forms within a downtrend, representing a period of uncertainty and potential exhaustion of the selling pressure. The second doji candle forms right after the first one, suggesting continued indecision in the market. Finally, the third doji candle completes the pattern, indicating a potential reversal to an uptrend. This doji candle forms above the previous two, signaling a shift in sentiment and the emergence of buying pressure. In the bearish tri-star candlestick pattern, the formation consists of 3 consecutive doji candles. A doji candle is characterized by having open and close prices that are nearly identical or very close together, resulting in small or non-existent bodies. These candles indicate a period of indecision and balance between buyers and sellers. In the bearish tri-star pattern, the first doji candle typically forms within an uptrend, representing a period of uncertainty and potential exhaustion of the buying pressure. The second doji candle forms right after the first one, suggesting continued indecision in the market. Finally, the third doji candle completes the pattern, indicating a potential reversal to a downtrend. This doji candle forms below the previous two, signaling a shift in sentiment and the emergence of selling pressure. The thrusting pattern consists of 2 candlesticks. Let's uncover its secrets. The first candlestick is a bearish candlestick, indicating a prevailing downward trend. However, the second candlestick is a bullish candlestick that opens below the previous day's close and attempts to push higher throughout the trading session. But here is the catch. The second candlestick fails to close above the midpoint of the first candlestick, signaling a lack of bullish conviction. Despite its upward momentum, it thrusts back into the bearish territory, failing to establish a strong bullish presence. As traders, we can interpret the thrusting pattern as a potential continuation of the existing downward trend. It suggests that the bears still have control and the bulls' attempts to reverse the trend have been rejected.